2. All right, you guys, good morning. If you were just dialing in, I used the word schnockered and said that's a expression of somebody getting super drunk. If you've never heard that expression before, well, now I put you on, and welcome to group coaching. You guys, it is the final Wednesday of 2022. We got a lot to be grateful for. We have a lot to look back on, but we also have a road ahead. And the reason why I wanted to bring Sosi in today, and we'll get into official introductions in just a moment, is I wanted to make sure that you guys have a full understanding of what's happening in the market. Sosi has a way of delivering information that is really easy to digest versus you guys getting lost in the numbers, walking away from this conversation a little bit like, well, I don't know if I can relay that, but that session was good. Like, I want you to have some pieces of information that you can create some content with, that you can deliver to your consumers, and it gives you a sense of clarity. So we're going to get into that conversation in just a couple minutes, but I'm going to turn it over to, let's see who's on. You know what? Andrew Lynn, he's now, is it the advisory board for the YPN in Southern California? Is that what you're on?
It's actually for the statewide advisory board for YPN.
Congratulations to you. I love that video of you all singing. Andrew, I'm going to have you bring us out on the field, and Sosi, and for all of our guests on the call today, we always have one of our team members just bring us out on the field. That means we're walking out onto the field through the tunnel. So Andrew Lynn, big dog, appreciate you. Congratulations on YPN, but let's hear from you.
So it is Wednesday, everyone. And what does that mean? It's hump day. So it's the middle of the week. It's time to get our weekend set, our appointments, our open houses. Even though it is the New Year's, there are still people shopping for homes. And I know I've been working with a lot of buyers that are like, I'm ready to go. I'm getting everything ready for and prepped for the new year. So take the opportunity for the last 3 days of the year to get 2023 up and running and get some buyers and sellers out there next week. So let's get the year started off.
I love it. Andrew, I have a quick question. In 2023, what is the market going to demand of you? Who do you need to be in order for you to have the year that you truly are destined to have this next year? Like, who does Andrew need to be?
I need to produce more content and be more visible on social media. And that's something that I've been lacking and need to do a lot more of. So
listen, Andrew, I think that it's time that you get yourself an accountability homie in Southern California or in Northern California. It doesn't matter. Somebody that's going to say, you know what, Andrew, we're meeting at the office today and we're going to shoot some content and we're going to buddy up on this. What I believe in 2023 is going to happen is that you're going to see this evolution of true collaboration on videos, right? That you guys are going to be able to create videos and put your different spin and different voices and different energies. So Andrew, I want you to get an accountability person, because how many people have ever felt Andrew's spirit when he's on the calls, when you meet him in person? If you've ever seen this dude dance, that's it, right? This dude's got some dance skills. So what I want to do is I want to encourage you, I want to push you. I love you, man. I'm here for you, but somebody be his accountability homie, and let's make sure that we are getting him on camera like nobody's business in 2023. So I love you, man. Appreciate your contribution. So as we get started, you guys, I want you guys, as we're cruising along this conversation, put your questions in the chat below, whether it is questions about interest rates, forecasts, things like that, because I'm sure there's going to be a slew of different questions. And so I want to do an official introduction to Sosi, and I'm going to turn the mic over to him, and I'm just going to fade out in the background, and I'm going to be a student learning from you, my man. So I had an opportunity to meet Sosi, and who's your partner? His last name's Bowie.
A buddy of mine, Mark Bowie.
Mark Bowie. So I always say Kevin because we have a Kevin Bowie on our team. So Mark, so he did a social media workshop for us in Southern California that was absolutely fire. His conversations and his videos on social are fire. It is an amazing delivery, great content. And so he's like, hey man, let's link up. I'd love to do a market update for your team. I'm like, cool. You know how I am, you guys. We're super selective with who we bring on to group coaching. And so I was like, absolutely, let's do this. Here's what I want everyone to understand, that the better you understand the data, the better you are able to articulate it, the more of an expert that you are seen as by your consumers. And then when you understand this information, then you can go and create content and flip it and make sure that it comes from your voice. And so I'm stoked about today. I'm excited that we're ending the year as our last guest with you. And so let's go full tilt today, my man, full stream of consciousness. I'm going to introduce Sosi and have you tell a little bit of your background. So I'm just going to turn the mic over to you, big dog. And then at the end, we'll leave some time for Q&A. So without further ado, my man, Sosi, let's go ahead and take it away.
What is up, man? Thank you so much. Am I coming in well on the audio?
You are, yeah.
Okay.
It's a little loud. You could
Let me turn down my gain a little bit. Is that better?
Perfect.
Sick. All right. Well, guys, I'm so excited to be here. And first of all, thank you for letting me be a guest here on Keep It Moving Coaching. I'm freaking so stoked about the name because it doesn't mean everything's perfected coaching, right? It doesn't say everything's good and no one has any crap we go through coaching. It's the keep it moving, which implies that there's momentum that needs to continue on. And that's the way I live my life, right? I've never hit this peak of like, okay, I'm there. No matter what success we hit, no matter how many people we've helped, how many families we've served, it's always this continual growing timeline. And so I'm a huge fan of everything you guys do, and I'm super honored to just even be here as a guest with you guys to be able to talk through all this stuff. And so today, if you guys have your notepads and your pens, or if you're taking notes on your computer, be ready. We got to cover a lot. And so let me share my screen real quick. Elias, is that all right for me to share my screen? Sick. Let's see.
You got it.
Beautiful. There it is. All right. Let me know if you guys see this on your end. Sick. All right. Well, today's market update, we're going to be calling the Special Ops Report. Seeing that there's a lot of military acronyms being used here in this next year because we know it's going to be a battleground, I thought this would be super fitting. If you're not following me on IG, shameless plug, there's a QR code. Feel free to scan it. I'll show it at the end again. And so if you're like, I don't know if I should follow you yet, at the end, if you think you should, the QR code will be there for you again. But what does OPS stand for us today? It's going to be opportunities, programs, and strategies. And so again, this is not just going to be a rate update or any of that boring stuff that we all know we go through and we hear on plenty of email newsletters that get sent to us. This is going to be more specific and very in tune with what you need for next year. So jumping right in, let's first talk about something. Market challenges, right? What market challenges are we having? Well, first of all, let's talk about with clients. With clients right now, the majority of clients are falling in one of these three challenges that we see. Rates are too high for me to buy now. I'm going to wait for a better deal when the market crashes. Or I'm going to do nothing with my house because my rate is so low. How many of you guys have seen those kind of challenges? Yeah? Okay, I got some hands. Sweet. Here's a real challenge, right? Like we hear this because we hear this and there's some fear that gets stricken in our heart. And I'm being honest here too, right? Like as this market has shifted, I have also been like, where's my footing? I've experienced fear, anxiety. I've gone through just even some small bits of depression going, man, am I going to be able to make this work? Blah, 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 right? Because we're not used to having real clients say, man, rates are just too high for me to buy. We're not used to having clients say, I'm just going to keep waiting. And then the feeling and the atmosphere is more intense than ever before, right? We've heard them say, I'm going to keep waiting, but it was a lot easier to deal with those who said, I'm going to keep waiting last year when you go, hey, rates are so low, you're going to miss out, right? Like this has been a new context. And so the real challenge of this market, especially as we go into 2023, the real challenge is skill, talent, self-belief, drive. And as I say all of these, whose am I talking about? Again, going back to my story, for any of you guys who don't know my story, I used to be a pastor, and I loved the role I had. So I oversaw Bible colleges internationally, domestically. I traveled a ton, so I've done about 22 countries, and I left that pastoral role because there came a season in my life where I started seeing some changes that needed to be made. And one of the biggest changes that I saw that drove me into the mortgage industry was seeing that my mom had someone who loved her so dearly from our church, someone who cared for her so much, yet had good intentions with bad advice. He was a loan officer who ended up getting my mom into a bad loan. We lost the house we grew up in. She had a really bad financial setting after that. And, even at this point, I'm just blessed to be able to have her live with me and help her get back on her feet as she's already standing to. But the reality is she should have never been in that situation to start with. And so as I have come from this place 6 years ago, wanting to create a mortgage practice that deals with clients differently and puts them into a different scenario, not just keeps them away from bankruptcy, but brings them into a new aspect of wealth that they could have never even imagined before. As I've been trying to do this new practice, I will tell you, this year, again, I had a ton of fear, I had a ton of anxiety, and I had a lot of uncertainty. And I started using the words to explain how I was feeling. I'm scared of the market, or I don't know what this market's going to do. And then all of a sudden I had to get really real with myself, right? And this is why I like the keep it moving piece. I had to be very honest with myself and ask myself, am I really scared of the market? Or am I scared about how I'm going to perform? And those are two very different things. One is external, one is internal. And the internal piece clicked in and I said, you know what? It's not about the market. It's about my belief in my own skill, in myself, in my talent, and in my drive that I have to own this market. And so as we look at market challenges, yes, we're going to talk about market challenges with clients and the words they're using. But it would be very, very irresponsible of us to not take a moment to examine and ask ourselves, if I have any fear with the market and as I project 2023, is it truly external based? Because that we can deal with. We're going to go through data today that's going to help you have a better confidence intellectually on the market and your success. Or is it something deeper? Is it something that is at my core where I just don't have the confidence in myself as I should have? And if the latter is true, I would encourage you and offer up for you to explore some diary sessions, some meditations. Reach out to me personally. I'd love to be able to connect with you. I know you're an amazing coach that continues to push through life no matter what life pushes towards him. Would love to speak with you as well. But know that both are actually the challenges we have, and we should not be ignorant to the latter just because it's more difficult at times. So for these first challenges on clients, all these are going to be answered by the end. But again, that real challenge, if you need more help with that, don't overlook it. Press in, let's connect, and let's get you confident in what you have, because what you guys have the opportunity for right now is insane. Let's talk a little bit about this. First and foremost, the opportunity you have is to protect the consumer. So let me make sure this goes away here. There it is. When you look at the headlines, right? And if you guys have followed me on Instagram, you've already seen this before. But headlines as of housing today, a bubble larger than 2006. It is better to rent than to buy in today's market. Next year will be hard on the housing market, especially in big cities. Guys, each one of these article headlines came from a different season and time, all the way from October 2015 to July 2021. And if the average consumer would have listened to these news headlines, they would have lost a total of $222,000 in total appreciation nationwide on average. Think about that for a second. Think about the people that you know that are going through sufferings right now financially. Think about people that you know that recessionary impacts are having on them, and what a difference $222,000 can make in their life. Think about that and realize that the first benefit you have, and the first thing you need to realize, and I need to realize and remind myself every day in the role we hold, is that we have the opportunity to protect and change a consumer's life for the better. Because the information they have out there will continue to make them now be enslaved into a renter nation where all these big corporations will buy up their housing and give it back to them at an extraordinary monthly rent price. So this opportunity we have, right, to protect the consumer, we have to take it with a high responsibility. And so let's talk about some of the pieces. And this part, I should kind of give a clarity. We're not going to have enough time for me to go through all of these. But I do have another market update that if you want to DM me, I'll send it over to you. Just send me a message saying, can you send me the market update? And I'll send you that over. I go through nine talking points of reframing the past. And what I mean by that is that when people today are sharing that they're scared or that they're not sure what's going to happen or they're thinking that it's going to be another 2006 crash, and I'm sure many of you guys are already equipped with this, so that's why I'm not going to go into it as well. But there's 9 talking points that we can use: inflation, the Federal Reserve, what recessionary periods actually look like, the supply and demand factors, the lending practices, equity, foreclosure rates, year-over-year growth, that even in counties like Santa Clara, we're still seeing a year-over-year growth, right? Current transactions being done, that there's still business being done overall. There's some really great data conversations there to have. And so we can go into those on a separate conversation, or you guys can just watch the recording and send me that message. But a couple things I do want to speak about these 9 talking points. Number one, first and foremost, when we're looking at what's happening in Santa Clara specifically, and is this okay for me to kind of go into this county specifically, Elias? You good with that?
Sure. Santa Clara, I mean, Contra Costa, whatever you see, man.
Whichever you prefer. I just went on the.
I think Contra Costa is our biggest population, or Alameda. So Alameda would probably be the best for the sake of content. But either one, man, it's your show.
All right, let's do it. So I'm going to try to see if I can switch this over to Alameda. Year-over-year growth. Oh, no, it's still Santa Clara. So let's see. This is what happens when you don't use Redfin a lot. That's what I get for doing an Audible. Okay, well, I'm not going to know how to use this tool, so I'm going to stick with Santa Clara. So with that for the moment, one of the things to kind of show here, right, as we're looking at 2023, look at the numbers of how it is. For every 1,000 people available, every 1,000 people, there's one house available. That's stinking crazy, right? Guys, think about supply and demand, and I'm sure you guys all know this factor, right? Supply and demand. The less there is of this good and the more people who want it, the more expensive this good gets. And what we're going through right now is a season where people are like, I still need that, but I'm going to wait a little bit, right? We're having a shock factor happen. We're having a sticker price factor, right? We're having this moment where people are going to have to get reaccustomed to what reality is, because there's some hard pills to swallow, and we'll talk about those today as well. But the fact is that dam is just building. The supply is not getting much better, and the demand is not getting better either, because there's more and more millennials coming of age to buy a house. So we can have less buyers, but it's not going to actually balance out what we need as far as a healthy economy on the housing side to be able to bring prices to any lower position of what some people are projecting. We'll talk about all these factors later, but one quick data point to show you guys here. For these 1,000 people that one house is available, right? We'll look at the 1.89 million total population here. 199,000 of those are renters who can afford a purchase. Talk about not having any buyers. There's 200,000 renters in one county who can actually qualify and afford a purchase. And when you look at these numbers, when you look at the household formations, right, these millennials who are coming of age to be able to buy as well, there's 17,910,000 of these millennial first-time home buyers that are wanting to buy. And again, it's already off balance, right? We only have one house available for every 1,000, and there's only 5,700 new builds there in this county. What does that show? That shows that no matter how scary it feels right now, the reality is not changing. The unbalanced housing market is still in the same position. We don't have enough houses. We have way too many buyers, and we have more buyers being added. And once that dam breaks, it's going to be over. And so let's talk about what that dam could look like here in a few slides. But going back to this, let's look at opportunities, right? In our ops example, opportunities. The opportunity right now for a buyer, right? They can buy without a bidding war in many cases. They can buy with potentially asking lower than listing price in many cases, right? There's not one size fits all. Every single county is different. Negotiations for repairs could potentially be brought in. Potentially, they can get all the appliances without having to negotiate in the same way they did last year. They could get even potential credits for the HOA payments. So if they wanted to have some of that HOA covered for the first little bit, they have those credit opportunities. They can get credit for closing costs. They can buy in the market, right, where it's not the market of greed, right? This is where everyone's scary, so you could be greedy. But most of all, and this is one of the ones that I love the most, they can get credit for buy downs. And I know you guys have probably heard a good amount about this, but let's go into what this looks like so you can see truly how it can impact the client, right? I'm not just going to talk to you about the program. Let's talk about how that program fits. So as we're looking at the programs, let's explain a little bit about what these are, right? So we have opportunities. You have that opportunity to negotiate with the seller in a way that we didn't before. That's massive. Programs, jumbos, yes, we have really cool arms, right? That's the majority out there. If you're a luxury agent or anything like that and you don't have those connections or understand the arm products or the IOs or anything like that, send me a message. We could talk more about that. But jumbos right now, you're just looking at arms mainly all day. Conventional loans, here's where the buy down really hits. Right? This credit factor that everyone kept talking about for a while, this is the money-making opportunity for most people today. First and foremost, there's something called the seller buy down. That's how we used to market it, right? The seller buy down is this math. You guys ready for this? If you're writing it down, be ready. For every $10,000 of credit that you can get from the seller, for a permanent buy down, which we used to market as a seller buy down strategy, that will equal, on average, a $30,000 price reduction. So what does that mean in English? That means in English, if you are looking at buying $1 million house, the payment for that $1 million house with a $10,000 credit to your buy down would be the same payment as getting that house for $970. You guys follow that? So that's the permanent buy down, right? The temporary buy down came more in popularity just in the last 6 to 8 months. Temporary buy down is very different than the permanent buy down. And if you guys are asking questions, let me look at the chat to make sure I'm not missing anything here. Okay, not missing anything. So if you have questions on the buy downs, this would be a really good time to ask it. Permanent buy down is a full buy down, right? A temporary buy down is something very, very different. What is a temporary buy down? You guys good with mechanics? Because I'm going to share with you the reality of it, right? I'm not going to share with you how it's marketed. I'm going to share with you the reality. Temporary buy down is typically in two forms. There's a 3-2-1 buy down and there's a 2-1 buy down. We market it like, hey, you're going to buy down your rate. That's not really what's happening here. So for those of you guys, realtors, that are like, this sounds iffy, right? Like it sounds dirty. It sounds like I'm doing pick a rate again. It sounds like this weird stuff. I understand. Let me share with you what's happening in reality, right? What you're doing is you're having the seller give you credit and you're taking that credit and putting it in an escrow account, right? An impound account that the mortgage company holds. That money is being put aside, and month by month, that money is being allocated to pay the difference of what your payment would have been at that higher rate in comparison to the lower rate. So if you get into 6.625, let's say, the monthly payment difference between a 6.625 and a 4.625, let's call it $500 for even numbers. That $500 is being taken from that impound account that the seller's credit went to pay the difference of your payment, so that you as a consumer are paying the payment as if it was that lower payment. Not rocket science, right? Here's the benefit of this conventional product that allows a temporary buy down. If you do the seller buy down, the permanent one, then you refinance, which is what the projection is. Projections right now is that rates will be going down by Q2. Think about that. If rates go down Q2, what happens to purchase prices? FOMO hits, that dam breaks, and it is going to be a crazy season. So know your products now and use that anticipation of what's coming to help your buyers know that if they wait too long, they're going to miss out on this small window of getting products like this. But let's say you refinance, right, within the next year. Permanent buy down, you spent $10,000 on that permanent buy down. Great. You lost all $10,000. Temporary buy down, whatever money's left over in that impound account, it goes to your refinance. You're having the seller pay for parts of your payment and potentially pay for your refinance later on as well. That's crazy, right? Okay, I'm sorry, I'm still lost. Okay, let me re-explain it one more time. In permanent buy down, I'm guessing that the 10K translates 30K because of interest paid over time. It's not interest paid over time, it's the monthly payment. So the same monthly payment for a 970 house on the permanent buy down would be the same payment you would have on $1 million, but buying down the interest rate with that $10,000 credit. And then Ben, on your end, which part are you lost in? Feel free to write that in as I go through the next section. Okay. Next section, right? So we went through jumbos, we went through conventional loans, homeowners and investors. Homeowners and investors. The programs for these guys, right? This opportunity where they can negotiate with the seller in a new way. The programs for these guys is, number one, if you're a homeowner and you have just increased your equity and you're that person going, I'm not going to make a move because my rate's too low. Awesome. Have you heard of a HELOC? And let me clarify, I don't even do HELOCs. I just love talking about them because they're so beneficial to consumers. A HELOC is a way that you can tap into all that $200,000, $300,000, $500,000 of equity that you've grown in the last 2 to 3 years with your home without having to touch that rate that's in the twos. And with that money, you can do some crazy things. I'll explain one of those crazy things in a moment. But investors right now as well, they're looking at their portfolios, and if they're wanting to go get different deals where the rents will be higher, or if they want to reset their depreciation or do whatever other things that need to be done, 1031 exchanges are crucial right now. So if you don't have a good 1031 exchange partner, try to find one, get yourself educated in that, because the investor world is coming in really, really strongly. If you'd like to chat with me on that, let me know. Again, DM me. Okay, going back to the HELOC piece. Let me share with you guys one of the most recent posts I did on Instagram here recently. Let's go to yesterday's post. So this reel that I did was just kind of an information one. Think about this, right? There's a couple things to note, and I'm going to go a little geeky on you guys. So if you were lost on the temporary buy down, feel free to not pay too much attention to some of the detail because you might get lost in this too. But I'll give you the end summary, right? So here's what to know on this. If you make over like $120,000, effectively what you were used to doing years back, when you can take a rental property, do all your deductions like you guys do on your taxes, right? All your income, you deduct it. And when you go to the negative on a real estate property, you were able to take that negative amount and apply it to the income you made. So let's say you married couple, one of the partners has their rental property. It was negative 20,000. The other couple is a doctor, or partner is a doctor. They're at like 200,000. This negative 20 would make that 200, 180 for simple examples, right? That's what you could do back in the day. Can't do that anymore. Once you make too much money, you don't get that benefit of taking a loss from your real estate portfolio. But there is a loophole, right? Everyone loves loopholes. You guys all love loopholes? Yeah. I see Mr. Cooks over there. He said he loves loopholes, right? Here's the loophole. If you could be identified as a real estate professional or a material participant, it changes the game for that loophole. That doesn't mean a real estate agent. This means that if one of the partners can show they qualify to be the manager of the property effectively, spending over 100 hours, 50% of the time, there's a couple different pieces depending on which one you're looking at. They then can take whatever negative they did and apply it to that ordinary income through something called a cost segregation. So again, I'm going to get lost in details, so I'm going to try not to, but here are the steps that you could do if you want to simplify this for people. If you make a lot of money and you want to get a really good tax benefit and you have a lot of equity in your house and you don't want to touch your rate because it's in the twos, this is perfect. Tap into your equity with the HELOC. Buy a second home with that HELOC, so that down payment just used from the HELOC. Use Airbnb or VRBO to generate income on that property, right? And so effectively, you'd want to make sure through different resources we'll talk about in a second to identify if it's going to be cash flow. And then from there, use the cost segregation strategy And then from there, take the savings you just used and either buy another property or pay down your HELOC. I personally have bought another home with just the HELOC. That home is on Airbnb generating enough income to cover my payment on the HELOC and the payment on the new home. My tax strategy on that is going to save me a lot of money. Like we're talking about in the 100,000 realm, right? And that's able to now be utilized to help me go buy another property or just pay down my HELOC. And the way we're doing that is because my partner, she is qualifying as a material participant to be able to make this move forward. This isn't a boast of Sosi, right? What I'm trying to show here is that more than ever, understanding your programs and understanding that what makes you money is not because you provide good service, it's because you provide advice-based solutions, strategies, right? When I've spoken with lawyers, I remember I spoke with this one lawyer and I was like, I got to ask you a question. A super successful lawyer, and I was just like, what's the difference between you and LegalZoom, dude? Because, like, seriously, I see some of the stuff you do. I see what LegalZoom does. I'm not trying to have any offense to you or disrespect. I just am really curious. What's your take on it? Why would somebody use you and not LegalZoom? The guy looked at me and he said, 90% of what I do and what LegalZoom does is exactly the same. The difference and the true money-making difference and why I'm worth more is that 10% of advice that I provide and solutions I give because of my experience and knowledge and skills. Dang. Right? At that moment, I was like, I got it. Thank you. You just gave me new encouraging pieces for my practice. And so, guys, we went through opportunities. We've gone through programs, right? There's some programs here. And if you want to get more into the nuts and bolts, let's talk through it. What about strategies, though, to put a bow on this? Strategies. More than ever, right, with first-time home buyers, especially in high-cost areas, house hacking and sequencing is so important, right? If you're trying to buy your first home and offset the rents with a different amount, awesome, right? There's so many millennials that I've seen that have high income. They're scared to death of making a move. They've never been reminded that they can actually look at buying a house, living in it for a certain amount of time, or buying units, living in one of the units, renting out the rooms or the other units, helping offset their mortgage payment until they feel comfortable to take it all over, or they want to move out and go buy another one. Sequencing. When you're looking at partners together, a lot of times people think, hey, this is a big commitment for us. It's an emotional part of our journey. That's awesome. Let's both be on title and let's both be on the mortgage. That might not always be the best case. If you're trying to have your portfolio grow later on, it might make more sense to have one partner be on one house and the other partner be on the other house. So maybe one partner be on the title and not the mortgage. And then 12 months later, we can help them qualify for the other mortgage without being implied by this one. There are strategies to everything. The sequencing of 4 units to 3 units to 2 units to 1 unit is super important, right? We got to make sure underwriters are going to be on our side and give us exactly what we need. And in the last 10 minutes, we're going to go through this a little quickly. Long-term and short-term rentals, right? Huge. I just shared with you guys one major strategy to get that done. 2 websites that you guys should have in your pocket at all times. So if you're writing notes, make sure to write this one down. For house hacking especially, or investment properties especially, rentometer.com. Rentometer.com, right? If you want to look at what rents are, or if you want to give it to your clients so that they can look up rents in a different area, go to rentometer.com. It's going to be a really good resource for you guys to just be able to look at, see what the projected rents are. It'll show you anything from the 25th percentile to the 75th percentile and give you a good projection of what your rent should be. Short-term rentals, look at airdna.co, right? It's one of the better websites out there. There's a few others as well, but this one is a tried and true. Go to it, check out the occupancy rates, check out what the annual revenue is projected to be. Before your clients make an offer, they can see what the numbers would be, and from there, they can decide if it's good or not. Buy, rehab, rent, refinance, repeat, right? This is something that has become so popular in the last few years. How do you get this done with clients? Hard money loans or renovation, right? You can utilize renovation loans to be able to buy this property that needs to be rehabbed, rehab it, and then from there, depending on what loan program you use. A little bit of time or a little bit longer piece of time, rent it out, refinance, and then repeat again. Last one, equity upgrades, right? More than ever, especially through HELOCs. Again, you can renovate your house, you can do ADUs, and more importantly, you can even transfer down your wealth to your next generation without having to have them bring money out of pocket, right? Is everyone here familiar with what's called a gift of equity loan or a gift of equity purchase? Right? So you can literally give all the down payment to your family member without having to bring anything out of pocket on their end, and you can still walk away with money. Elias, sorry, brother.
No, I just wanted for clarification, is you said Air DNA, but on the screen it says DND. Is it DNA or DNA?
Air DNA.
Okay, cool.
Got to get the marketing
That's it.
team on that. Cool. So with those four, right, there's so many strategies that we can use to be able to bring this all full circle for the client. And so this is how we'll end. We look at opportunities, we look at programs, and we look at strategies. And all this should make us really pumped up going, I can have a lot of conversations with clients, right? When you're being told, hey, make sure that you're doing your dials or whatnot, or make sure you're doing your content, you're like, what topics do I talk about? All of these. Right? Talk about what loan programs there are effectively if you want to share that and you feel comfortable with that. Talk about more specifically what strategies you're seeing help clients win. Look at house hacking testimonials online and share those with other people. Call your clients and chat with them about what upgrades they want to do. Yeah, they're locked into their house and they're in prison because they're in a 2.875 rate, but that doesn't mean that they don't have to prepare for the next sale, right? What if doing a HELOC and renovating the house because they know they're not going to want to be in there forever and you know you can't talk them into it. So let's just do some renovations, have the HELOC finance it, and then in 7 months when rates go down and now they're like, if I'm ever going to move, it's now's the time. This is my one chance of freedom. Cool. Who prepped them to be able to have the house renovated in such a way so it could sell at a higher dollar? You did, right? The opportunities you can create for yourself right now are insane. And believe me, I'm preaching to myself on this stuff. It is going to be a very challenging market, but the key to it is going to be coming in with what gets us paid. Advice-based solutions that help change the life of not just the consumer you serve, but the grandchildren that they'll have later, right? This is what we're doing. And so let's finish it full circle here. Let's talk about influencing people. And this is our last topic here in the last 7 minutes I have for our conversation. I believe I was supposed to be done at 9:20. Influence formula. All of us here, right? When we think about opinions we have of the present, these opinions are being formed from something in the past. And so if you guys are fans of reading or podcasts, I've learned this specifically from a coach and mentor of mine named Rene Rodriguez. He's a fantastic guy, wrote a book called Amplify Your Influence. Really, really good. Check him out on podcasts, all that stuff, right? But effectively what he showed was that we all base our opinions, our thoughts about the present moment with the fuel of what is coming from the past. So when I look at the market today and I see, this slow moving market and I have this feeling of, oh my gosh, like prices have gone too high, there's a bubble, I'm starting to fill in those gaps in my mind with what's the past. And so therefore we're going to have a market crash, and therefore the economy is going to go down, and then therefore we're going to see prices drop like crazy, right? And what we have to do, and I'm sure you guys are tired of it already, is we have to get clients to see that today was not the same as 2006. And you guys, I know, have done a fantastic job of that. You have done really good at reframing somebody's now to be different than what their opinion was of making it equivalent to 2006. But what that does to your client is it only neutralizes your client. Okay, cool. It's not 2006. So what? Right? And we don't want to neutralize our clients. We want to empower them. How do we empower them? We show them what the future holds. So guys, watch this. Think about one of your clients who we talked about in the beginning. Rates are too high. I don't want to buy. The market's coming. It's going to crash. I'm going to get a better deal. Let's look at what happens. Here's a reality, and here's a hard pill to swallow. This person who's been waiting to buy, and they got a little discouraged in the beginning of this year. Let's say they would have bought in January, a $800,000 house. That $800,000 house would have gone for $850. With that 3.75 interest rate, they would have been at $3620 a month. And now they're at $800,000 at a list price, right? If it's listed for $800,000, it's probably going for $800,000 or less. So let's say it goes to list price instead of $50K above like last time. With the current rates, let's say it's 6.625, the payment is like $1,400 higher. No, I'm not going to cuss here, but no crap, right? That buyers are like, I'm not making any moves. So what do we do? Here's the reality. Number one, there's really good programs, right? There's a 3-2-1 buy down. They'll bring them to like a 3.625, so they'll be in a better scenario for the first year. But let's talk about the 2-1 buy down because that's typically an easier one to get. Their payment can start at $4,257. That's $600 difference now, right? And if they're pushing against you and they go, no, I just want to get it at $750. Okay, well, let's look at again the differences. $750 with the same rates, $4,748. The thing that gets us the most savings are the buy downs and the exit plan for the buy down, because every single good financial decision should be analyzed on what the exit strategy is a refinance, right? And so if you do refinance, what's projected to be 4.5 interest rates from all the projections I've seen here in the next 24 months or 18 months now, 4.5 would bring you to 4,209. Is it the 3620? No, it's not. Is it for sure a lot closer? Yeah, it is. But what's the alternative? Right? I think people get stuck here and they're like, I just don't want to do it until I go back. It's like, what's your game plan? And a lot of times what their strategy is hope. It's not data. And we have to walk them through the reality that waiting is going to cost them. So let's say you don't want to do the $800,000 now, right? Well, $800,000 if rates go up 7.625, right? That's going to be $5,496. If prices go up and rates stay the same, it's $5,381. If prices go up but rates drop, it's $4,941. If prices drop and there's higher rates, it's $5,153. Guys, the reality of all this is that hope does not necessarily, it's not going to equate for them just savings immediately. That's not how it works. Being able to create solutions for them to make moves now, have opportunities now, have solutions now is going to be a far better strategy than wishing upon a star and not running the numbers and not seeing that it truly doesn't work out like they're hoping. So with all that, I know that's our time. We're not going to go through some of the other pieces. But let's just talk about any questions.
Yeah, if you can stop sharing your screen.
Yeah.
So I think that we're definitely going to do another session with you. We'll coordinate something because I think that there's a lot to unpack here because I see a lot of people shaking their heads. Yes. But there was a question from Dan that I wanted to go to, but something you said early on, my man, that really stood out to me is intellectual confidence, right? That the real challenge might not be the market. The real challenge may be the excuses and the confidence you have within yourself that not only is in this business, but might be in other parts of your life and business, right? And so we can choose to make this an excuse, but is it really the market, or is that something that we battle internally, man? And that's a really good conversation. That's a powerful conversation. So I thought this was amazing. I want to turn it over to the team, and I wanted to go over to Dan Sunberg. Dan Sunberg had a question in the chat. Dan, I'm going to have you just ask your question out loud, big dog. I thought that was a good question. And then anybody else, just go ahead and raise your hands, and we'll try to get through as many as we can.
Yeah, thanks, Elias. I was wondering if you could walk through, is there like a monetary difference between taking a $10,000 credit up front versus getting the 2-1 or 3-2-1 buy down from a $10,000 seller credit? Like, is the buyer actually saving more money one way or the other?
Yeah, good question. So if we're only looking at the 10K, typically a permanent buy down is what's going to be best, right? The 2-1 buy down usually comes with more credit needed. And so two things I would throw out there. If you know more credit's needed and the seller's not willing to budge, one of the strategies we've seen be super helpful is don't just let the client walk away. We add the credit to the purchase price if you believe the appraised value will be there.
So
And
I
I know
think
that's, go
I
ahead.
think my question is maybe coming at it from a different angle of if you've negotiated $10,000 in credit from the seller, flat out, they've agreed to a $10,000 credit. Is it financially any different for the seller or the buyer to get that right up front at the very beginning, or to get that over the period of the 2 or 3 years in a 2-1 or 3-2-1 buy down or credit or whatever?
It's typically better to do 2-1 buy down if you can get enough credit. What I was trying to share is that $10,000 won't usually work for a 2-1 buy down. Right? So like if you're only getting 10K, then the only option you really have is a seller permanent buy down. Because a 2-1 buy down usually comes at more credit than just 10K depending on the purchase price. But
Okay.
if let's say we have the equivalent amount of credit, right, for the heart of the question, hey,
Yeah.
which one of these two is better? The 2-1 buy down is more savings because it gives you more exit strategies, right? Like when you look at using all that money for a buy down, yes, your rate goes down permanently, but you're still going to most likely refinance, right? And if you're still going to refinance, all that buy down you spent doesn't get you really much benefit. There's not a lot of tax benefit anymore in today's tax code for those pieces, depending on, how much money you're making and all that stuff. But in addition to that, it's lost money because if you refinance, that's all down the drain. The 2-1 still gives you that money access for the next refinance.
So what about comparing that though to the third option of just cash in the buyer's pocket, that they're not using it for a rate buy down, but they're just, less 10,000 or whatever the number is less for closing costs?
Yeah, I'm a huge fan of less capital on my stuff for a better cash on cash return. And so I'm a huge fan of that. What I've seen the hurdle for most people is that they would rather have a lower payment in most cases than have more cash in their pocket. And we do have to coach them through that too, right? We have to go through the statement of what do you think is going to save you from financial hardship? A $200 payment cheaper on a monthly basis or $10,000 more in your bank? Right. And so that does help people go, okay, you're right. There's a reality I'm not considering here. But at the same time, too, when the payment is $1,600 higher, to just get them in the house, we're just saying do the 2-1 buy down. Because if not, they just won't do it.
Got it. Okay.
Awesome. Great question, Dan. Quan, you had your hand up, big dog. Can you put your camera on for your contribution or your question?
Uh, I'm still getting over a cold.
Okay, never mind. I hear the sickness. Go ahead and shoot, big dog.
Yeah, it's not pretty right now. Hey, fire presentation. Thank you so much. One thing that really stood out for me was when you talked about basically when you explain to folks the difference between what happened in 2006 or whatever fear they had before versus the reality of what is today, you're just neutralizing the situation, which I know I'm really good at doing. But it's the next piece that that was kind of like the aha moment. It's like, all right, now you gotta create momentum. Now you gotta shift people to pull them towards something better. Yeah. So being able to communicate that piece, to be able to show them a brighter future on why they need to take action now is that was like the piece that now I'm like, okay, that's what I need to work on. So I would love to, we need to do like another session just on that piece. I think that'd be super powerful. And then I had a really just quick question. When you talk about the permanent buy down, what is the maximum, like percentage wise? Let's say if someone is locked in right now at a conventional at 6.25, like what is the maximum you can actually, like, with money you can throw at it to buy it down? Can you buy down a whole entire percent with with FHA at like 6 points, or what is the maximum amount of the percent you can actually buy down on the rate?
Dude, that was such a intelligent, insightful question. I don't know if everyone caught that. I do want to clarify something. When you hear a lot of times like lenders talk about these buy downs, one thing that's overlooked is the secret sauce of how an agent needs to write these buy downs into the contract, right? And the reason for that is because there is a max limit with guidelines of how much buy down a consumer can get, and also what a high cost loan would be. And so one of the workarounds to this to try to get the most juice out of the fruit, let's say, or the most bang out of your buck, is making sure that in the contract it's specified that the credit is going towards seller buy down points. That there allows that max issue to not be a big factor any longer, because now it's no longer the buyer using a certain amount of points to buy down the rate. It's the seller, so therefore it comes off of the buyer's obligation, and on compliance it makes it work. The other fact to your question is how much can you get per loan program, right? How much seller credit can you get? Because that's really going to be your limiting factor. And so your limiting factor there on a conventional loan, and I can send you guys some more slides on this too, and I also have it on my Instagram if you guys want to look through that, what the max concessions are. But I'll probably just go on my Instagram and send it over to you. But effectively, if you're looking at a conventional loan, depending on how much down payment you're doing, it's going to be anywhere from 3 to 9% max, right? Typically it's 3% if you're looking up to 10% down. And if you're doing 10 to 24.9% down, you're going to be looking at 6% limit. FHA is a lot easier. FHA, you could usually use about 6%. So I've been in some crazy scenarios where 3.5% down is all they have, and we needed to work out the stuff for the DTI and a couple other factors. And so we did 6% credit for the buy down, temporary and permanent. You can also mix it and do both. And so FHA there is 6%, but I'll send a link here in the chat so you guys can have it from my Instagram of what the max concessions are.
Awesome. Love it. We have time for one more question, and then we'll go through key takeaways for the day. So does one more person have a question? Going once, going twice. All right, let's do this. Let's go around the room. Let's get a couple key takeaways from people that are on the call today. Let's go to Lauren Ibarra. Lauren Ibarra, high level key takeaways from our session today.
Obviously, I think like the nuts and bolts, being able to speak about different offerings.
So no, sorry. I was just responding to Lucy, but I'll come to Lucy next.
Nuts and bolts, but it really stuck with me when you talked about the strategy. It's like, yeah, 90% of our jobs is the same as, whatever, but being able to be that differentiator and kind of like an ally, I think super valuable. So thanks for sharing.
Love it. Love it, Lauren. Let's go to Lucy Spencer. Lucy Spencer, you had a question. Let's hear your contribution and question.
Hi, everybody. Okay, thank you so much, Sophie. That was really great information. For me, when I'm working with a buyer, I work very closely with my lender to make sure that I fully understand like all the potential options and how I need to write my offer. Because the last thing you want is to open escrow and then you realize you didn't ask for enough or it's not going to work out. Now your client's freaking out because they come in with a ton of money.
Yeah.
So one thing that I've learned is, the different cost factors for all these different loan types. And so that could be huge if you're working, especially with somebody who doesn't have a lot of money on hand. So in looking at like the 2-1, I think it's my understanding that the 2-1 costs a little less than the 3-2-1.
Yeah.
And I understand like the buyer also needs to contribute to that buy down. It's not just a seller credit. So I think just making sure like everybody understands like these 2-1 and 3-2-1 options are actually pretty complicated, and we got to make sure that we're protecting our clients at the end of the day.
Yeah, I couldn't agree more. And so one of the things I did is if you guys look at the chat, I sent the websites that we create for our clients. And this is where you could see the numbers that I went through with the 2-1 buy down and then the what if prices go up, the cost of waiting piece. So if you guys want those slides to share with your clients, as I see Ben's question, click on those links, save those links, share those links. They're super effective. But to your point, Lucy, right? Every single one of our clients that we help, they unless it's a fire drill and they need to place an offer yesterday, which we have found is not the majority of clients. The majority of clients do want to do their due diligence. We have a 45-minute consultation that we go through. And in that consultation, we do go over trends, identify fears, and we truly partner with you, right? And this isn't a plug for our team, but this is my reality of what I think the industry is going to go to. The necessity for a hybrid relationship of value from the lender and the realtor is going to be way more in the future than ever before, right? Like you see consumers searching out mortgage information even before they go see houses now. From a lead generating standpoint and from a conversion standpoint, the relationship is going to be so imperative for both to be intellectual people that can give advice and win over the client, even for one another. And so that website that you see, this is at a 45-minute consultation we do with clients, and we go over the costs. One of the factors with the buy downs, though, the temporary buy downs, is that most loan programs require it to be from the seller credit. So we do share with them that we need you to get X amount of credit if you're looking at this purchase price. And if you're looking at this purchase price at this amount of credit, and we make sure the agent knows, because to your point, we need to make sure no one gets bad surprises. The thing that I've seen not work well is when, you know, we work with a new agent that's not really familiar with these, and they're advising the client like that the program works in a different manner, and it doesn't work that way, right? Like if we're not on the same page of how much credit is needed for every single one, like I've had scenarios where the offer is accepted and it's $10,000 less of credit than we needed. I'm like, one, no one told me the offer was even placed. I couldn't call the listing agent within the 24-hour commitment we have. And then two, this doesn't work anymore. And so to your point, it's so important. Make sure you know how much credit is needed. Make sure you understand those numbers. Make sure you have the resources like websites like this that you know the client is viewed and the client can refer to, so that you're not stuck in the middle being that middle person of like communication and messing it up, you know, having to do all that stuff there. So that's my answer to that one. Hope that helps.
Great stuff, Lucy. What I would recommend for everybody is that I strongly encourage you to work with a lender that is your strategic partner and that is also your coach and your strategy coach, right? Like, hey, bring all the information to that person. I would get the lender involved early on your buyer's consultations. There's tons of lenders out there. And if you don't have somebody that's looking further down the road as Sosi, as our other lender partners, then it's probably time for you to change. Nice. We literally have 30 seconds, bro. Do you have a quick contribution, quick question? I want to make sure to keep everybody on time.
Yeah, I put it in the chat. I was just wondering if he can share the link that he showed us with that stat page or whatever, where he went from.
Yeah.
It's a PDF. So if you want to just DM me your email, I'll email it to you and just tell me what county you want, and I'll send you that as well.
Can you just do an email to me with some of the links and stuff that we covered today?
For sure.
I know that chart that you showed, that is a paid subscription, correct?
Yes. Yep.
Okay. So if maybe you could just send that information, that way if we want to join, we can join. But here's the thing, you guys, this is amazing information. Obviously, we're going to continue to have these conversations. Huge shout out to you, Sosi, for just bringing so much great value to the team. Quick request for everybody, if you guys took a video, you took a picture, please tag Sosi and I on social media. We want to build the buzz. And then on Friday, you guys, I want to pack the house. It is our last group coaching of 2022. We've came a long way this year together. And so I'd love to hear takeaways, thoughts, biggest lessons. I mean, let's just have a fun day on coaching on Fridays. So Sosi, much love to you. Mad appreciation for you. I'll be reaching out to you. Just had a couple other questions. Friday's also Maria's birthday. So Maria, let's be on. Let's celebrate you. So listen, you guys, as always, keep it moving towards your dreams, goals, and vision. And I appreciate you being here, Sosi, and thank you guys for spending this hour with us. So get out there, have some fun. And if you have some great notes, put your camera on and create some cool videos about this today. Sosi, thank you so much.
Have a great day, guys.
Bye, you guys. Have a great day.